This past year we did 1.3 million in premiums for 24 clients. Today we're going to be talking about how to maximize your pension with indexed universal life. Now, most pensions have one of two options. For a school teacher, for example, usually the first option is you can take the higher amount, let's say $5,000 a month. That goes to you guaranteed for the rest of your life. Or you can take $4,000 a month, but if you pass away early, your husband or your other spouse will continue receiving the $4,000 until they pass away. Usually the person helping them with the pension is going to say, you would like to include your spouse in this, right? Of course they would. So they nod and they go with the second option. Now, this isn't a bad option, but there are other options to still protect your spouse. Today we're going to go over the ones that are actually better. Now, if we choose option 2 here, there are two guarantees. The first is that the $4,000 a month will be paid out to you or your spouse as long as one of you lives. The second guarantee is that we're not passing on any sort of death benefit when we are deceased. Where this can really sting is if one of you doesn't live much longer than expected. You spent your whole life working, putting money away to get this big pension. You both pass away, but you only used it for so long. Your heirs do not inherit the income from this pension or a lump sum of any sort. Everything is done. Now, the more uncommon choice here would be to go with option 1, taking the higher amount, but still maintaining those guarantees. How do we do that? That is through splitting up this $5,000 into two categories. The one is the $4,000 a month. That's what the two of you are going to live on. That's what you would have lived on if you had just taken the second option. The other is the $1,000 a month. And what you're going to do is you're going to fund a cash value life insurance policy. This allows a number of different things. Number one, if the other spouse predeceases you, you're going to continue to get the higher amount, and you're going to have a large death benefit that's been building up that you can pass on when you pass away. Number two, if you pass away early, you can set the death benefit high enough to make sure that that lump sum is going to be able to create an income stream for your spouse that they would be able to live off of. And if they pass away early, they still have a death benefit to leave behind as well. Number three, if neither of you pass away early, you continue to live on into your later years. You'll have a much higher number that both of you can pass on when you both pass away, or you can start pulling from that number through tax-free withdrawals or policy loans to increase your own income. Fourth, another thing here is if the spouse that's not receiving the $5,000 passes away first, and the spouse that's receiving the $5,000 is to be remarried, you can also redesignate the beneficiary to be the new spouse. So in this case, if you were to pass away, they are left with a lump sum. The income doesn't stop with you and your previous spouse. Now, depending on the other income streams that one has, the risk tolerance, there's multiple different ways to do this. Number one, let's take a look at if a 60-year-old male was putting in $1,000 a month and they structured this policy to have the least amount of death benefit at all times, structuring it for max growth, what it would look like. First, that's $12,000 a year, $1,000 a month. We can see on the right the death benefit after year one is $130,600. The risk here is if they pass away early, you still will get a larger death benefit, but this isn't going to be enough to fund the living spouse's lifestyle. This could be an option if you have other insurance or there's other streams of income to where this isn't totally necessary. This is the optimal way to structure it in terms of long-term growth. So if we continue to scroll down here, we can see the death benefit's going to continue to get bigger, the cash value is going to continue to get bigger. And in this case, 30 years in, if you were to live to age 90, we have $780,000 in surrender value. This is going to be how we get the largest number in 30 years right here, but it's not going to protect against those early years quite as well. In this second example, we didn't set things up optimally for growth, but instead we put a minimum death benefit that we know is going to be able to cover and fund the spouse's living expenses if you predecease the second spouse. That number we picked $300,000. Of course, it could be much more or lower than this, but in this example, you can see if we scroll down to age 30, we have $778,000 30 years in, which is going to be lower. However, if you were to have passed away early, we had this $300,000 there the whole time to protect against that and still leave a big enough lump sum behind to where the remaining spouse could turn this into income. Now, what's also nice and flexible about this method is that if the spouse that is not included in the pension passes away before you, what you could then do is at any point you can reduce this $300,000 death benefit to the minimum amount that the insurance company will allow it to be, That way you're not paying for the additional insurance. And then from there, the policy is going to be able to grow structured for maximum growth that you can then access later in your life. Or if you don't want to access that, let it continue to grow, have it pass on completely income tax free to your heirs. Now you both had that money, used it for your entire life, funded your lifestyle, and left behind money to your heirs. You didn't just spend your whole life working, putting money into this pension for you guys to pass away and leave behind nothing to your kids. Hopefully this was helpful. You realize there's a number of different ways to structure these policies based on other sources of income, based on your goals, based on your cost of living, adjusting that for inflation. But you can begin to see why this option can be much more beneficial in terms of transferring money to heirs and even providing you with a higher lifetime income in the long haul. If you'd like to take a look at how this could work for your own pension, book a 20-minute quick consult with myself down below. I'd be happy to help. Bye-bye.